Welcome to the debate. So I want you to imagine that you've secured your life savings in this state-of-the-art reinforced steel home vault.
Okay, a pretty standard setup for a lot of people in this space.
Right. And you believe it is, entirely impenetrable. But then 5 years later, you discover this horrifying truth. The steel itself has been secretly porous the entire time.
Oh, wow.
Yeah, it's completely vulnerable to anyone who knows exactly where to push. I mean, you would probably move your assets to a regulated bank immediately, wouldn't you?
I think any rational person would. Yeah.
Exactly. And that is the exact psychological mechanism we are examining today regarding the explosive rebound of U.S. Bitcoin spot ETFs in August 2026. Because after a historically dismal period, these funds just saw their best week in approximately 3 months.
It was massive. We're talking about net inflows between $626 million and $1 billion, depending on, the exact measurement window you're looking at.
Right. And we are drawing from recent financial and on-chain reporting to dissect a core disagreement regarding this massive influx of capital. I will be arguing that a catastrophic security failure in a highly popular hardware wallet fundamentally destroyed the trust in self-custody, and that rationally drove this capital toward the regulated safety of Wall Street ETFs.
And I'll be taking the opposing view. I will argue that attributing a near $1 billion institutional macro rebound to a localized retail hardware hack is, well, it's a convenient myth. It completely ignores the actual mechanics of institutional dip buying and broader liquidity cycles.
So let's unpack the catalyst here, because the severity of this hardware hack, it really cannot be overstated. We are looking at the recent compromise of CoinKite's Coldcard wallets.
Right.
For years, the rallying cry of this asset class has been, not your keys, not your coins.
The absolute golden rule.
Exactly. But the data from TRM Labs shatters that absolute security myth. There was a firmware error, specifically version 4.0.1, that had been quietly sitting in these devices since March 2021.
March 2021, so over 5 years.
Over 5 years. This error weakened the seed generation entropy from a secure 128-bit encryption all the way down to a highly vulnerable 40-bit encryption.
Which is a catastrophic downgrade.
It is. The immediate result was 1,816 Bitcoin, which is roughly $116 million just drained across 5,200 addresses. And the attackers never even needed physical access to the devices.
Wall Street analysts from Cantor and FRNT Financial are entirely correct in their assessment right now. Investors are migrating capital to ETFs because they've realized they prefer regulated counterparty risk over the completely opaque, supply chain risks of hardware self-custody.
Look, I understand the gravity of the hack. It's terrible. But correlating a specific firmware exploit to a massive institutional ETF rally is, it's an enormous leap.
You don't think they're connected?
I think it completely lacks any longitudinal flow data to support it. If we want to understand why $1 billion suddenly flowed into these ETFs in August, we have to look at market mechanics, not a localized retail panic. But $116 million stolen isn't just a localized panic, is it?
It is when you look at the macro picture. July 2026 was the worst month of the year for ETFs. The entire month saw only $172.43 million in net inflows. And if you look at the first half of 2026, we saw $5.4 billion in net outflows.
Right. The market was exhausted.
Completely exhausted. So the money entering ETFs right now is just institutional capital buying the dip, led heavily by BlackRock's IBIT. This capital is operating in a macroeconomic sphere that is frankly entirely disconnected from the retail hardware wallet market.
I see your point on the macro conditions, but I think you're underestimating how a technical failure of this magnitude reverberates through the entire ecosystem, including institutions. Let's talk about what entropy actually means in this context, because it is crucial to understanding the panic.
Sure, lay it out.
If you're listening to this and wondering why a simple firmware bug costs $116 million to vanish, it comes down to randomness. Entropy is the mathematical foundation of your private key. It's the randomness used to generate it.
Right.
128-bit encryption is so complex that it would take longer than the lifespan of the universe for all the computers on Earth to guess your key. But when that firmware bug dropped the entropy to 40-bit, a modern laptop can brute force a 40-bit key in a matter of hours.
Yeah, it becomes trivial.
Exactly. The hardware device itself, the very thing designed to generate true randomness, was generating predictable, easily guessable patterns. And here's the fatal flaw. Merely updating the firmware doesn't protect you.
Right, because the seed was already generated with compromised entropy years ago.
Exactly. If you generated a wallet on that firmware anytime between March 2021 and the patch, your vault is permanently porous. You have to assume it's compromised, generate an entirely new seed on a trusted device, and physically move the funds.
Which is a huge operational headache.
It's more than a headache. Any rational actor, whether they're a high net worth individual or a family office, looking at that catastrophic failure of the hardware supply chain is going to experience a fundamental shift in how they view risk.
You think they just abandon self-custody entirely?
I do. They aren't going to just buy a different brand of home vault. They're going to say, I am not equipped to audit cryptographic entropy. I will let BlackRock custody my exposure.
Wait, let's unpack that, because you're taking a very real, very unfortunate technical failure and you're projecting it onto the behavior of Wall Street hedge funds.
Because they manage risk for a living.
But let's look at what security experts are actually saying about the broader landscape here. Ido Benetton from Blockade points out that the vast majority of crypto losses in early 2026, in a year that has already seen over $1.2 billion in security losses, by the way.
Right. It's been a rough year.
Yeah. But he points out those losses stem from operational failures. We're talking about phishing scams, key compromises, and user error, not fundamental protocol flaws.
But the Coldcard bug was a fundamental supply chain flaw.
Yes, the Coldcard situation is a severe supply chain issue, but it's still a localized vector. What the Wall Street analysts at Camptor are doing is constructing a highly convenient narrative to explain complex market behavior.
Convenient how?
I challenge you to provide actual empirical data showing that retail holders whose 40-bit Cs were compromised took their remaining capital, opened a brokerage account, and bought shares of BlackRock's IBIT. That one-to-one flow data simply does not exist.
Well, the lack of a direct one-to-one on-chain audit of retail to ETF migration does not invalidate the psychological shift that we can clearly see occurring. The timing is just too synchronous to ignore.
Timing isn't everything, though.
We're talking about a perfect week of positive inflows across all 5 trading sessions in August, immediately following the public fallout of this hack. You can't tell me that's pure coincidence.
But synchronicity isn't causality. Look at July 31st. That day alone saw gross outflows of $265.4 million. What we saw in August with that $626 million to $1 billion inflow is classic mean reversion.
Just bouncing back from the bottom.
Exactly. It's institutional capital looking at depressed asset prices, looking at the outflows from the previous month, and deploying dry powder. The fact that the Coldcard hack happened simultaneously is a coincidence that analysts are using to write tatchy research notes.
That is an interesting interpretation. But even if we concede that institutions are the primary drivers of the volume, we have to look at where this capital is actually settling, because the destination of these funds reveals a dramatic shift in risk profiles that perfectly aligns with a flight from self-custody.
Okay, where is it settling then?
During this massive rebound week, BlackRock and Ethereum ETFs absorbed roughly $896 million. BlackRock's IBIT alone now commands 79% of the trading volume across all 13 U.S. spot ETFs.
It's a behemoth.
$61 billion in inflows. Now, you might say this is just institutional dip buying, but look at the fee structure driving it. BlackRock charges a 0.25% fee. Grayscale charges 1.50%. And as a result, they've bled $27.42 billion.
The fees matter, absolutely.
But it's more than just fees. This intense concentration proves investors are actively seeking out the largest, most secure, regulated players. They want institutional-grade security because the alternative, whether it's an expensive trust or a risky hardware wallet, is simply no longer tenable.
I don't disagree that capital is concentrating in BlackRock, but I fundamentally disagree with framing it as an absolute triumph of security. Have you considered the systemic risk this exact dynamic creates?
Systemic risk from regulated ETFs.
Yes, you are celebrating the fact that BlackRock, Fidelity, and Grayscale now control roughly 89% of the assets under management in this space. You look at those numbers and see a flight to quality. I look at those exact same numbers and see a massive, terrifying centralization of systemic risk.
How is it terrifying? These are heavily regulated entities with world-class custodial infrastructure.
But they're single points of failure.
We are talking about multi-party computation, geographically distributed cold storage, and intense regulatory auditing. It is an entirely different echelon of security than trusting a piece of plastic mailed to you from a hardware manufacturer.
Let me use an analogy here, because it highlights exactly why this is so concerning. Moving capital from thousands of individual hardware wallets into a few mega ETFs is like moving everyone's money from thousands of individual home safes into one massive, impenetrable vault.
Which sounds like a good thing.
That happens to be built directly on top of a tectonic fault line. Yes, it's much safer from individual burglars. The multi-party computation, which for our listeners is a way of splitting up private keys into mathematical shards so no single person holds the whole key, is technically brilliant.
Right, it's incredibly secure.
But you are exchanging a localized, distributed risk for a centralized, catastrophic one.
I'm not sure a tectonic fault line is a fair comparison to the custodial architecture of Fidelity or BlackRock.
It is the perfect comparison when you look at the blast radius. If 1,000 people lose their Bitcoin because of a Coldcard firmware bug, that is a tragedy for those individuals. It is localized damage.
Sure.
But when 89% of the asset class's regulated capital is held by 3 traditional finance behemoths, a single stress event transmits directly into the broader financial system.
Like a regulatory freeze?
Exactly. If there is a regulatory freeze, a custodial breach of their prime broker, or a systemic liquidity crisis, we are no longer just talking about crypto-native retail investors taking a hit. We're talking about pension funds and retirement accounts now holding indirect exposure to these single points of failure.
I see.
By concentrating it in BlackRock, we haven't eliminated risk. We have just changed its flavor and massively increased its blast radius. And we are doing this in an environment where the rules aren't even fully written yet.
Ah, you mean the regulatory void. I'm actually glad you brought that up, because the regulatory situation right now perfectly illustrates my point about just how desperate investors are for the ETF structure.
Desperate enough to ignore the risks?
Yes. If you look at the broader environment where this massive capital deployment is occurring, it is incredibly fragile. Let's look at the Clarity Act, H.R. 6333.
Right.
This was supposed to be the definitive market structure law, clearly delineating jurisdiction between the SEC and the CFTC. It was supposed to provide the map for that fault line you mentioned, but it is completely stalled in the Senate.
Dead in the water.
The poly-market odds for its passage in 2026 have plummeted to 17%, and the vote is delayed until at least September 14th, with the midterm elections breathing down lawmakers' necks.
Exactly. The legislative branch is paralyzed, which means these ETFs are operating in a massive void.
But that is exactly my point. We are currently operating under a joint interpretive guidance from the SEC and CFTC issued back in March 2026. If you're listening and wondering how the market functions without a law, it functions on this guidance.
Which is incredibly flimsy.
It is merely administrative. It's a temporary, reversible taxonomy that could theoretically be undone overnight by a new administration or a hostile agency chair. Yet, despite this massive, glaring regulatory uncertainty, we just saw $1 billion pour into these ETFs in a single week in August.
Right.
Why would anyone deploy capital into a legally ambiguous environment? Because the ETF structure itself, the protection it offers from the terrifying realities of 40-bit entropy bugs and self-custody hacks, is so highly prized that investors are willing to ignore the regulatory void entirely.
You think it's all driven by fear of self-custody?
I do. I have to push back on your skepticism here. Are you not underestimating the psychological impact of demand completely decoupling from regulatory certainty? People are so eager to offload custody risk that they don't even care that Congress hasn't codified the rules.
I see the logic in that argument, but I am not convinced by it. Because you're still misinterpreting who is actually deploying that capital. You're trying to map retail self-custody fears onto institutional capital flows.
Well, institutions have fears too.
Sure, but let's use the exact same regulatory data you just cited, combined with on-chain metrics to look at what is actually happening beneath the surface. The fact that demand is persisting in a regulatory void doesn't prove that people are terrified of hardware hacks. It proves that this is purely institutional macro behavior.
How does it prove that?
Retail investors generally wait for regulatory clarity, right? They want to know the rules of the road before putting their life savings in. Institutions, however, trade on probability, macroeconomic conditions, and structural arbitrage. They don't need the Clarity Act to pass to buy a dip.
Okay, so what specific on-chain metrics support the idea that this is purely institutional, independent of the hack?
Let's look at the data from Arkham Intelligence. Throughout this entire August rebound, 0 ETFs sold any Bitcoin. None. It was entirely one-sided accumulation.
Pure buy pressure.
Pure buy pressure. BlackRock bought $111 million on August 3rd alone. Fidelity added $33 million. Even Franklin Templeton made their first purchase in over 30 days.
Now, couple that with the data from Sentiment.
What did Sentiment show? We hit 712,000 active addresses, a 3-month high. But more importantly, we need to look at the whale transactions. Transfers over $100,000. They hit a 5-month high with 61,800 transactions in a very short window.
Right, that's a lot of large-scale movement.
It is. This isn't a panicked retail user in their basement realizing their Coldcard is compromised and rushing to open an E-Trade account. These are automated trading desks and deep-pocketed institutional whales executing complex dip-buying strategies entirely independently of any retail self-custody concerns.
But those automated desks,
they are looking at the $5.4 billion that exited the market in the first half of the year, seeing a mispricing and stepping in with immense force.
I don't deny the presence of institutional whales or, the automation involved. But we have to remember that institutional capital is ultimately managed by human beings.
Of course.
Human beings who read the news, who sit on risk management committees, and who have to justify their allocation strategies to their boards. When a story breaks that $116 million was stolen without physical access, because a Canadian hardware manufacturer shipped a device that generated 40-bit entropy instead of 128-bit, that risk committee makes a decision.
And you think that decision happens overnight?
I think they decide that managing private keys internally or trusting third-party hardware to do it is an unacceptable operational risk. So they call their broker and buy IBIT. And to your point about the whale transactions, you have to understand how ETFs actually work behind the scenes. Those massive $100,000 on-chain transfers you're citing, those are the ETFs themselves moving the underlying asset.
You're referring to the authorized participants.
Exactly. For our listeners, an authorized participant, or AP, is essentially the bridge between the traditional stock market and the blockchain.
Right, the market makers.
Right. When institutional demand for an ETF like IBIT surges, the APs have to go out and purchase the underlying Bitcoin to create new shares of the ETF to meet that demand. The ETF spot creation and redemption mechanism directly translates the demand for the ETF into those whale-sized on-chain movements you're referencing. So the on-chain data doesn't disprove my point. It illustrates the exact pipeline of capital fleeing into the safety of the ETF.
Look, you are accurately describing the creation and redemption mechanism. Yes, when demand for IBIT shares increases, the authorized participants purchase the underlying asset to create new shares, registering as large on-chain transactions. However, you are still assuming the motive of the ultimate buyers without evidence.
It's the most logical motive given the timing, is it?
A risk management committee at a major hedge fund doesn't need a hardware hack in August 2026 to realize that managing private keys is difficult. They already knew that.
True, but
That is precisely why they waited for these ETFs to launch in the first place before allocating capital. The institutional money was never going to use a cold card. The outflows we saw in July and the massive inflows we saw in August align perfectly with standard quarterly portfolio rebalancing and macro liquidity shifts.
So it's just business as usual.
Exactly. It's a natural market rhythm, not a sudden revelation about cryptographic entropy driving them into the arms of BlackRock.
Yet, even if the primary driver is macro rebalancing, we can't ignore that the broader narrative surrounding self-custody has fundamentally fractured this year.
It certainly has taken a hit, yeah.
The philosophical purity of the asset, the idea that you can be your own bank securely, is violently colliding with the practical reality of securing digital bearer instruments against supply chain attacks.
On that point, we are definitely looking at the same reality, even if we weight the underlying catalysts differently.
We certainly converge on the sheer scale of what occurred in August. It was a massive, undeniable market rebound. Seeing a perfect week of positive inflows across all 5 trading sessions is a striking display of market strength.
It really is.
Regardless of whether it was triggered by a technical paradigm shift or a macroeconomic opportunity.
Absolutely. The data is indisputable there. And I think we also agree that the resulting landscape is one of extreme, almost unprecedented concentration.
Unprecedented for sure.
With nearly 89% of ETF assets now held by a few mega firms, we're looking at a brand new structural reality for the financial ecosystem. The risks haven't disappeared. They have simply centralized.
Which leaves us contemplating a deep philosophical paradox embedded in all of this data. We are watching an asset class that was designed to eliminate middlemen become entirely dependent on them.
The ultimate irony.
It is. The future of this space seems caught between 2 incredibly difficult choices. You either assume the heavy, unforgiving burden of individual sovereignty, risking everything on the mathematical integrity of a manufacturer's firmware,
Right.
or you accept the systemic counterparty risk of traditional finance, concentrating unprecedented power and blast radius in the hands of a few asset managers operating in a regulatory void.
It is the ultimate trade-off of our time in this space. And the flow data, those billions of dollars moving in a single week, shows us in real time which path the vast majority of capital is choosing.
It really does.
There is an immense amount of nuance left to explore and how these custodial dynamics, these authorized participants, and this massive centralization will reshape the market in the years to come.
Indeed. We started this discussion by imagining a home vaults with porous steel. As the billions continue to flow out of self-custody and into the institutional vaults of Wall Street, the lingering question for every market participant is simply this. Are we absolutely certain the centralized vault we are migrating to is any stronger, or are we just hoping the fault line underneath it never gives way?